Good morning, everyone. Today we'll be discussing the recent interest rate cut by the US Federal Reserve and its implication for the US economy as well as the emerging markets like India. The Federal Reserve, the central banking system of the United States, plays a crucial role in shaping the country's monetary policy. Their decision on interest rates can have far-reaching consequences both domestically and internationally. On September 18, 2024, the Fed made a surprising move by unexpectedly slashing interest rates by half a percentage point. This sudden change in the cost of borrowing money has caught many people off guard and raised important questions about its potential impact on the US and the global economies. As we dive deeper into the analysis, we'll explore the reasons behind the Fed's decision and the potential ripple effects it may have, particularly on the US economy and the emerging markets like India. Now let's dive deeper into the implication of Federal Reserve's rate cut. The Federal Reserve lowered the federal funds rate by 50 basis points, bringing it to a range of 4.75% to 5%. This decision marks a significant change in the Federal Reserve's approach to monetary policy, moving away from the rate hike cycle that began in 2022. The rate cut was prompted by concerns about a potential economic slowdown and rising unemployment in the United States. The Federal Reserve's decision to lower interest rates signals its effort to support the US economy and address emerging economic challenges. As we'll see in the next slide, the shift in the monetary policy by the Federal Reserve has far-reaching consequences, both for the US economy and the other emerging markets. The Federal Reserve's decision to lower the federal funds rate was primarily driven by the concerns about a potential economic slowdown and rising unemployment in the United States. Policymakers recognized the need to support the US economy and address the emerging economic challenges it faces. This rate cut signals the Federal Reserve's willingness to take proactive measures to stimulate economic growth and provide relief to consumers and businesses. By reducing the cost of borrowing, the central bank aims to encourage spending, investment, and job creation, ultimately bolstering the overall health of the US economy. Looking ahead, the impact of this rate cut will be closely monitored, as it sets the stage for potential further adjustments in monetary policy. The next slide will provide a historical timeline of the key interest rate decisions made by the Federal Reserve and other central banks, offering a broader context for understanding the current economic landscape. In the previous slide, we discussed the Federal Reserve's decision to lower the federal funds rate by 50 basis points, bringing it to a range of 4.75% to 5%. This marked a significant shift in the Federal Reserve's approach to monetary policy, moving away from the rate hike that had begun in the year 2022. The Federal Reserve's decision to cut interest rate was prompted by concerns about a potential economic slowdown and rising unemployment in the United States. This rate cut signals a shift in the Federal Reserve's monetary policy stance, reflecting its effort to support the US economy and address the emerging economic challenges. While inflation in the US dropped from a peak of 7% to an estimated 2.2% in August 2024, indicating a significant slowdown in price pressures, the Federal Reserve remains concerned about a potential economic slowdown and rising unemployment. In response to these concerns, the Federal Reserve has decided to pivot towards a more accommodative monetary policy, cutting interest rates by 50 basis points. It's worth noting that the rate cut of the session was not unanimous, with one Fed governor advocating for a more modest quarter-point reduction. This reflects the complex and uncertain economic environment that the Federal Reserve is navigating. In contrast to the Federal Reserve's pivot, the Reserve Bank of India has maintained a steady repo rate of 6.50% since February 2023, focusing on progressive disinflation and supporting economic growth. As we move forward, we'll explore the potential implications of the Federal Reserve's rate cut and the contrasting approaches taken by the Federal Reserve and the Reserve Bank of India in addressing their respective economic challenges. Building on the previous slide's discussion of the Federal Reserve's decision to cut interest rates, this slide explores the potential impact of this policy move. The rate cut could lead to a decrease in mortgage rates, making it more affordable for US consumers to purchase homes. Additionally, credit card interest rates may drop, providing relief to US consumers carrying balances on their credit cards. As businesses find it cheaper to borrow, they may expand operations and create more job opportunities for US consumers. The stock market often responds positively to interest rate cuts, as lower borrowing costs can boost corporate profits. However, the rate cut could also lead to a depreciation of the US dollar, potentially making US exports more competitive in global markets. Investors may also redirect funds from the US to seek higher yields in emerging markets like India following the rate cut. This potential impacts will be further examined in the next slide, which will explore the perspective of economists, market analysts, and policymakers on the Fed's decision and its implication. Let's now turn our attention to the implications of the Fed's actions for India. As the world's largest economy, the United States monetary policy decisions have a profound impact on global financial markets and economies, including that of India. We'll examine the four key areas where the Fed's move is likely to have significant consequences for India. First, the increased capital inflows. The prospect of higher interest rates in the US may lead to an influx of foreign investment into India as investors seek higher yields. The currency fluctuation. The Indian rupee may experience increased volatility as it responds to the changing dynamics in the global currency markets. Monetary policy pressures. The Reserve Bank of India may face challenges in managing its own monetary policy as it navigates the ripple effects of the Fed's action. The slower economic growth. India's economic growth, which has been a bright spot in the global landscape, may face some headwinds as the broader economic landscape adjusts to the Fed's policy shifts. In the previous slides, we discussed the implications for India's economy due to the divergent monetary policies between the US and India. This stark contrast has led to increased capital inflows, currency fluctuations, and monetary policy pressure, ultimately slowing India's economic growth. As we can see from the data, the US has an inflation rate of 2.2% and GDP growth of 1.5% in 2023, while India is experiencing an inflation rate of 6% and a GDP growth of 6.8% during the same period. This figure highlights the differing economic conditions and policy priorities between the two countries. The Federal Reserve's recent interest rate hikes have been in response to elevated inflations in the US, while the Reserve Bank of India has maintained a relatively tight monetary policy to combat its own inflationary pressures. This divergence has created challenges for India as it navigates the balance between managing inflation and supporting economic growth. Looking ahead, the Federal Reserve has hinted at the possibility of additional rate cuts, potentially totaling another 50 basis points by the end of 2024. This gradual approach allows the Fed flexibility to adjust based on incoming economic data. Meanwhile, the Reserve Bank of India's future policy decisions will be closely monitored by both domestic and global investors. While the RBI may not immediately follow the Fed's rate cut, it might consider easing its stance if inflation continues to moderate and growth concerns emerge. As we discussed, the RBI may not immediately follow the Fed's rate cut. It might consider easing its stance if inflation continues to moderate and growth concerns emerge. This could provide some relief for the Indian economy, which is currently facing higher inflation compared to the US. By closely watching the policy actions of these two major central banks, we can better anticipate the potential impacts on the global economic landscape and identify opportunities for strategic positioning. I hope you liked this small lecture on the recent US Fed rate cut, and in case you have liked it, please consider subscribing to my channel. Thank you so much. I see you in the next video.